Adjusting entries are the fourth stage in the accounting cycle. It occurs at the end of each accounting period, whereby they are posted to the adjusted trial balance from which financial statements are generated. But first, a bit of context. Adjusting journal entries are entries made in the general journal to record revenues that have been earned but not yet recorded, and expenses that have been incurred but not yet recorded. This is based on the accrual basis of accounting, where revenues are recorded when they are earned and expenses are recorded when they are incurred. All of this plays a pivotal role within the world of business because the exchange of cash does not always coincide with the earning of a revenue or incurrence of an expense. Therefore, adjusting journal entries ensure businesses can provide a more accurate representation of their net profit or loss during each accounting period. It also helps properly inform stakeholders of the business's financial performance for that accounting period. All of this follows the revenue recognition principle, matching principle, and also required by generally accepted accounting principles. You can compare this to the practical shortcomings of the cash basis system of accounting. Generally, there are four scenarios which would invoke the need for an adjusted entry. We have deferred revenue, where cash is received before revenue, deferred expense, where cash is paid before expense, accrued revenue, where cash is received after revenue, and accrued expense, where cash is paid after expense. And you can see the general journal entries that would associate to each of these at the end of the accounting period. Let's take an example. In March 2020, Chris Clean's Corona Proprietary Limited begins providing cleaning services at Virus University. It is business practice to not invoice the client until the end of the 12-month contract. At the financial year ending 30th of June 2020, 37 hours have been spent cleaning the premises at an average rate of $75 per hour. Record the adjusting entry for Chris. Now, having a look at this, we can see that we debit accounts receivable because Chris has provided the services valued at $2,775. And even though they have not been paid yet, they have earned that. And therefore, that's an amount that they are owed. Now, we debit accounts receivable because it is an asset account with a normal debit balance. On the other hand, we credit cleaning service revenue because they have provided cleaning services to the value of $2,775. So we credit this because revenue account has a normal credit balance. But let's look at this from another perspective. How would we record the adjusting entry for Virus University? Well, we debit cleaning expense because they've incurred that amount worth of cleaning expense. And because expenses are an asset account with a normal debit balance, we debit this. On the other hand, we credit accounts payable because they've incurred $2,775 worth of cleaning expense, but not yet paid this. So they still owe that amount to Chris. Hence, we credit accounts payable because it's a liability account with a normal credit balance. And that's how we do the adjusting entries for both parties.